What I love about the math of escape velocity is it's actually the exact same no matter what income you're on. It's an even playing field, whether you're a high earner or a low earner. If you're investing 20% of your income, you're going to reach escape velocity all at the same time, depending on your actual return on your investment. So there's two types of escape velocity. Contribution escape velocity, which is really simple, just you've invested so much into an asset and it's now just making more than you can even pay into it. You know, what you end up finding is like a daily price swing can be how much you might make in a week or a month. And it's almost like your own physical labour doesn't really put a dent in it anymore. The portfolio just becomes this organism and just grows without your contributions as much. Then there is the labour escape velocity. Labour escape is where your portfolio has enough growth in it that you technically don't need to work again if you don't want to. You know, personally, I think we should all work as long as we can. It gives you a sense of purpose, but it's the freedom that comes with the portfolio actually able to fund your life. But most importantly, contribution escape velocity, we should aim to achieve that. In this example, I've ran four income brackets: low, medium, high, ultra high. And I'm running them on various returns. So 9% is your standard, and I'm pushing it all the way up to 20% returns. And I'm going to get attacked for even daring to say you can get a 20% return, but I'm going to prove why it is possible. And we're going to show you how much of an importance this is. I'll tell you right now, your growth of your portfolio might be one of the most important financial metrics of your life. The difference between someone who's getting like a 12 to 15% return and a 9% return is about 11 years of physical labour. You know, someone who just wants the safety, the perceived safety, getting a 9% return, they're going to work 10 years more than someone else who goes after growth. And it's all in the mind, and it's education. So this is what I'm saying. This stuff. Your capital allocation skill is one of your most important skills financially. Because my question to you is, for getting these returns, what is the alternative? I'm always thinking, what is the alternative? You can set up a business, but the business is not going to compound at 15% or 12% for the rest of your life. You know, so we've always got to weigh it against the alternative. But let's look at the actual math. Straight away, what you'll see on the right-hand side, years from zero, it's the same for every income bracket. 8 years, 6 years, 4 years, or 3 years. So this person invests $6,000 a year. They're getting like a 9% return. Their portfolio needs to grow to $66,000. So it'll take them 8 years before they reach contribution escape velocity. But if they get a higher return, that is dramatically reduced. So if they're getting like a 15% return, 12% return, that will shave off like 2 or 3 years of their escape velocity. So years from zero is the exact same for all income brackets. Ultra high, say they are contributing 200k, they're on like $1 million a year. They're contributing 200,000 into like an all-world fund. They're getting 9%. Portfolio needs to get to 2.2 million. So it's going to take them a lot longer than if they're going higher returns. They can shave off like $1 million off the portfolio. So simply as the more concentrated the portfolio is, the more it grows. Straightforward. Now, this is how much you would need to have escape if you were going to sell the assets. Obviously, on this channel, we teach the buy, borrow, die strategy. So ideally, we don't believe in selling, but if you did want to sell, the portfolio would need to, for the lowest income bracket, they need to spend 20k a year. This is a big thing as well. This is all assuming someone never gets a raise, never works overtime, never has more disposable income a month, and their annual spend is fixed. Because normally what can happen is someone's annual spend might go up and it might go down, like it might change. Your actual annual spend will dictate labour escape velocity more than anything, because, you know, someone could be on a high income bracket, their portfolio gets to whatever, like $1 million, and they just, you know, they move to Vietnam, they can retire, you know. So, you know, it depends obviously on your annual spend. That really decides it more. But I have just assumed for the lower income bracket, this person's on 20k. I know that this wouldn't be realistic in America. You know, USA, you can't probably live on 30k a year, whereas you can in other parts of Europe. But it's just the math to put it into perspective. So let's say medium, right in the middle, they need 60k a year to live. If they're getting a 15% return, their portfolio could be 400k, but they'll take about 9 years to get there. Yeah, because the growth has shaved so much time from their low return. Would be need to work an extra like 7 years. Yeah, so this is what I'm saying. This is why this is so much more important, a skill to learn and focus on. Because if it's all in the mind, see, people think financial peace of mind is like a paid off house or a certain number in the bank, but it truly is financial knowledge. It's 100% financial knowledge. I always say this, the wealth gap is a knowledge gap. The wealth gap is a knowledge gap, because the difference between someone getting a 9% return and a 15% return is knowledge. And it's not like some secret knowledge that Wall Street have that you don't have, because it's so simple. I'll show it in a little minute. Labour escape velocity for buy, borrow, die. This is where you're never selling the assets. You're borrowing against the portfolio to fund lifestyle. It is superior for absolute wealth returns and generational wealth, but you do need a higher portfolio for it. And honestly, like, for the lower income, if someone's on a lower income bracket and they can't even, I just wouldn't recommend margin borrowing for people on lower income brackets or with no investments, because they're just looking for a quick fix. You know, and if I say to someone, you know, with a small portfolio, yeah, go ahead and use margin, they're going to blame me the minute the market crashes and they get margin called because they didn't do anything right. So I would never sign off on that. I've made a video before, like what net worth I think is needed to really execute buy, borrow, die, and 100% stand by that. But it's all long term. You know, it's a long term game. Usually, what I find is the lower income bracket want a quick fix. They want something to be solved right now. There's no long term horizon, and because the portfolio is their life, they're checking it constantly. They rely on it. They're in a scarcity mindset, and it just doesn't make a good investor. Someone in a calm peace of mind who, you know, they're getting on with their life, they're a better investor just because they don't have this much skin in the game. So there you go, 24 years it will take someone low income bracket on a 9% annual return. It's going to take a lot longer, as you can see. And they could shave it right down to like 12 years on a 15% or even 12% return, 16 years. They're near enough shaving off like 10 years of labour. And as you go down to higher income bracket, 21 years, 14 years, 11 years, 8 years. Yeah. And I've put in the cost of the loan at 5%. That can change. And there you go. What a difference it makes. Ultra high position. So someone chasing a 9% return, they would need to wait till their portfolio is $10 million before they could live off 400k, compared to 2.6 million if they had obviously a 20%. But let's make it more realistic, 5.7 million and a 12% return. The return is so important, and how do we actually qualify for the return? Okay, so first of all, the most important objection I'm going to get is, 20% return is just impossible. You can't do it. And how dare someone say that? That's the most common objection, because they cannot detach themselves from a company earnings to the stock price. So let's look at a good example of Meta and Google. Okay, so we're going to use Meta and Google in this example. There's a bunch of numbers on the screen. Let's just ignore them for a second. There's a game Wall Street play that what Wall Street can do that you cannot do. Sorry, the other way about. You have skills that Wall Street do not have. For example, Meta. Over the last year, it's down 9%. Now, Wall Street physically cannot hold that stock. They're on a 90-day window. They are the most reactive investors in the whole game. They are just running on narrative, and the earnings call comes out and capital expenditures gets announced. They sell the stock. They're reactive, constantly chasing the narrative. They have their full-time job is this game of Wall Street, the chaos of Wall Street. You can hold that stock for 1 year while it's down 9%, minus 9%. Yet retail can do this. Wall Street cannot do this. And this is something that is so hard to break through to people's psyche, because they think Wall Street have such massive advantages over retail, that the game is rigged. This is what the losers say. They say things like the game's rigged. In actual fact, the reality is it can be rigged in your favour, because you can buy and hold. So watch this, right? So there's Meta. Over the last year, stock is down. This is just a coiled spring because the company's still making money. Okay, so we're going to look at owner's earnings for Meta just for the last quarter. The owner's earnings grew 30%. 30% growth. The company's literal cash that it can spend grew 30%. So the actual company grew. Stock price doesn't reflect that. Look at the compounded annual growth of Meta and Alphabet, Google, over the last 10 years. Right, so you've got Alphabet has grown its owner's earnings cash by nearly 20%, Meta 25%. So these are examples of what I'm talking about. The law of the market is the stock price will eventually follow earnings. In fact, what could happen is, let's say Meta, for 5 straight years, the stock price stays exactly at 648. For the next 5 years, imagine that you held that company for 5 years while the owner's earnings is growing every single year by like 20%. The free cash flow per share, 20% growth. They're buying back the stock. But let's just imagine Wall Street do not touch it. And then after 5 years, the stock just doubles. Because that's what will happen. That's what would happen. Because it's financial physics. You can't shake that. If the company's continuously earning the money, eventually the market has to respond. So what would the typical person would say? Haha, see, look, you held for 4 years. You've held this stock. Oh, see, you can't outperform the market. Yeah, see, you can't outperform the market, because they're measuring it from like January to December, and it's just not how it works. You know, and then after 5 years, the stock doubles. You've made what, 20% compounded annual growth rate. But most investors just can't do that, because they can't look at a stock that's doing nothing, because they see memory stocks are going up. They see noise in the market. They want to chase the next best thing. They just can't do it. Psychology, they just can't do it, because they don't understand really what they're even investing in or why a stock even goes up. There you go. 2 companies. Now, the next biggest objection. Okay, for Google and Meta to grow another 20% over the next decade, it would need to have an annual revenue of 2.5 trillion. This is why retail investors do not invest in monopolies, because that's how they think. Their brain says, hold on, it needs to make 2.5 trillion, so it needs to like suck up like what 10% of the like GDP or whatever, and that's not how it works. Yeah, that's just the arithmetic doesn't work in the land of corporate finance. There's the earnings. grown. There's a stock price for Meta. Direct correlation to the company's earnings and financials. Here's what actually needs to happen in reality. Okay, so yeah, of course, if money was fixed and it was like a fixed pie for like Google to grow 20% every year for the next decade, practically the whole of America would have to spend its money on Google. Yeah, it just defies like the laws of money. But money is printed. Money is printed every single year, and the first place the money goes is into the top growth stocks. So you need to forget that money is not fixed. Money is printed and grows at 6.5 to 7% every year. Then the company buys back its own shares. So it's actual to grow this 20% every year. The company actually could just hike prices by 3 to 5%. That's just without acquiring new businesses. Like the Google Cloud has a backlog of like $400 billion of backlog. And AI revenues now being introduced. So you have to ask yourself, can the company hike its price by 3 to 5% every year and grow, 8%? But they get 30% of the work is done by the Federal Reserve by printing money in commercial banks. Because this is what I'm saying. If the average brain just says, oh well, the elephants can't gallop, trees can't grow to the sky, so they wouldn't touch a big company. So they think they need to invest in small companies. It's not quite the case. But you don't necessarily need to invest in single stock if you don't want to. You can do an ETF, like the NASDAQ is 40% of the NASDAQ is the hyperscalers, it is big tech. That's the companies that generate all the money for the market anyway. So the All World Fund anyway is just over diversification. You're effectively are buying a lot of dead weight in the actual S&P 500. I'm working on going through all the companies in the S&P to see how many is actually dead weight, and a lot of them are. Most of the market is honestly dictated by a tiny handful of companies. People are scared of that, but the concentration is a feature, it's not a bug. The power law exists, all money goes to a small concentration of monopolies. That's just the way it goes. So when you're diversifying, like in an all-world fund, you're carrying a ton of dead weight, all these markets, companies in these other countries with no pricing power. This is why pricing power is the most important factor in a company. It really is. If it can just increase its prices year after year, you got your compound growth, escape velocity right there. So there you have it. Now I'm going to start putting my spreadsheets onto Beehive. So I'm going to put this link in the description, and I'll start posting out valuations of companies, valuations of the NASDAQ, buy, borrow, die strategies, Lombard loans, all things financial, capital allocation. So link in the description for that, and you can start actually accessing the spreadsheets. As I say, this is the most important skill for financial capital allocation, and more videos coming very soon.